Yes. I welcome all our students for this third day of live revision classes. And today is the paper 8B, and we have faculty Logendra Umawat. And we have also with us Jay Charya, Central Council member, and I can explain him as a Prince of Surat, we can call him, or I don't want to read out his qualifications because he has all 4-line, 5-line qualifications, almost 37, I believe, if I remember correctly. He had having the qualification, presently heading the Skill Development Board, Skill Enrichment Board of the part of the Board of Studies that is known as BOS Operational. So over to you, Jai Bhai, to address the student.
A very good morning to Sushil Bhai, Lokendra ji, and my dear students. Thanks a lot, Sushil Bhai, for providing me this opportunity. Well, student friends, I am sure you must be very happy with this particular initiative of the Board of Studies for providing you with the revision, quick revision of your subjects within 1 or 2 days. I think it's a very good rate. Within 1 or 2 days, if you can complete the entire subject this way, this is definitely a boon. Great compliments to the Institute Board of Studies in particular. Friends, today the subject that you are going to cover up is economics for finance. And the first and foremost question arises as to why this subject has been included in the syllabus of the CA. You know, if you look at the syllabus of the CA, the previous syllabuses, then this subject was not a part of it. It is only in this first time in the CA syllabus this subject has been involved. It is the year 2013 while we were developing this particular syllabus for the institute. CRET, that is the Committee for Review on Education and Training, I was a part of that, and there was a deliberation as to, you know, why is it so that in the finance subject function, still more and more chartered accountants are not there. Let us understand one basic fact that, you know, on one side you have accounts and auditing, and on the other side there is finance. Though there is interconnection, there is some interaction, there is some overlap, but these are two distinct functions. And what is happening? More and more chartered accountants are going into the audit as well as the accounts, that is reporting field, and in the finance field, they have to acquire additional knowledge. And friends, one very good opportunity I can tell you in India, you don't find major institutes which are focusing particularly on core finance. Similarly, you don't have institutes that are, focusing purely on economics. Today, if you want to be an excellent professional in the field of finance, economics is perfectly inevitable. Without understanding the macros of the economics, there cannot be any person who can be an excellent, professional in the field of finance. Neither George Soros or Warren Buffett or our Indian Warren Buffetts, that is Mr. Junjunwala and Mr. Deo and other people who also happen to be chartered accountants. If you really want to be into hardcore finance, you want to be a good professional in the field of finance, economics, particularly macro, is inevitable. With this concept in mind, a small portion of economics of finance was introduced at the stage of intermediate. We also revamped the syllabus at the foundation level, removed some few topics and introduced some more practical topics. So let me tell you, this subject is very, very important for you, not only for the point of view of your examination, but also for joining the bandwagon of the finance professionals. That is one thing. And second, what I believe is not only important, this is a very interesting subject, a very, very interesting subject. Finance is, a field full of ocean of knowledge, and economics of finance is a very, very crucial topic. So it will be very helpful to your examination in your life. And I would just suggest that enjoy this subject, reading this subject. I was discussing with the Board of Studies Academics Chairman, and he suggested me that while you discuss with the students, also discuss about it. What is the approach to study it? I am sure you have an excellent faculty. Lokendra ji is there. We had some interactions with him, and he's a very good faculty, having very good knowledge on that. He will give you much more information on that, but I'll just tell you, whenever you approach a new subject, initially it is very difficult to grasp it. First, you don't link up with the subject. If you really want to link with the subject, if you really want to create an interest, first read the subject as a storybook. And these days, due to these lockdown conditions, you have some reasonable time, sufficient time. I would suggest not only the June students, but even the students who are going to appear in November, just do one thing. You have hardly some 150 pages or 200 pages book, hardly some 4 or 5 chapters, particularly in this subject. I would suggest, if you have not yet studied this subject, first, as a storybook, read the entire subject. If you don't understand, it's fine. Just keep on smiling if you don't understand. Let your family be confused why this person is smiling throughout the day. It's fine. First time, just go through the subject, read it. You will get some rough idea. You'll at least get a linkage, how the chapters, how the concepts are interlinked. Second time, when you start reading, be a little more attentive and you will try to understand it more. And then you can focus on some specific concepts where you require some more time. Because there might be some concepts where you require too much of time. And maybe some concepts, even after reading it thrice, you might not be grasping it. It's fine. At least when you will go through this, there will be only a few concepts on which you will have to work more. The first and foremost thing is approaching this subject with interest. That is the most important thing. So I would suggest, if you are not reading, just read it at a stretch. Maybe within 2 to 3 days, you can read the entire subject. And of course, today's session is going to help you in that. Now, today you are going to cover 2 very important topics. The first one being the national income and the second being public finance. And friends, believe me, this is something very, very important. Not only for chartered accountants, even for a layman, these concepts are very important. For particularly public finance is too very important. Today, under this COVID situations, we are telling about it that, India is safe because of the doctors, because of the police, and because of the healthcare people. But friends, you know what? After this COVID issue is over, when we'll be out of this pandemic, what is going to happen? The major challenge is the economy. How to revive this economy, how to revamp it, how to go ahead to that equilibrium position, how to once again elevate, escalate the various things in this economy, how to see to it that your GDP once again goes up to that extent, what are the various sectors and how you are going to work up, and how to once again form a good part in the foreign trade. So, this is all the part of economics. And you know what? The country is going to be like on the borders of the nation, you have the Indian soldiers protecting India. Similarly, in terms of healthcare, the doctors protecting us today. Similarly, it is going to be the economists and the financial professions which are going to play a very vital role. And there comes the chartered accountants, and there comes the importance of this subject. Believe me, if in India somebody is required today, then we require economists. We require good economists who can understand economics, who can, support the government, who can give proper suggestions to the corporates, Indian corporates, and coming down to even the MSME sector to develop. And this is what is the role of chartered accountants and the professionals in the field. Very quickly, if we touch up the subjects, of course, the faculty is excellent and is going to cover it very well. But just to give a glimpse, national income. I think it's a very interesting and a very simple topic, where you have to understand the different concepts like what is GNP and what is GDP. Single line concept is there. If something is produced within the geographical boundaries of the nation, it comes into GDP, whether the factor belongs to the nation or not. And if something is produced, some services or goods that are being produced by the factor of production belonging to the nation within the geographical territories or outside the nation, that will come into GNP. And there comes the difference between GDP and GNP. How to reconcile that comes NFIA. Similarly, there would be the concept of GDP and NDP. Of course, the difference being depreciation. I don't think depreciation is something, a new concept for chartered accountancy students. They can understand what is the difference. Similarly, at factor cost, at market price, what is going to be difference? How you might take the GDP or NDP at factor cost, how you can add the indirect taxes and deduct the subsidies. Subsidies is something we can say that the opposite of indirect taxes. Indirect taxes is what government collects from you, and subsidy is what government gives to you, gives back to the society, to the nation. So, if you take the net of the indirect taxes and subsidies and adjust it to GDP, you get the figure of GNP. Sorry, that is from the factor cost you will reach up to the market price. So these are some of the concepts of national income. You will learn the three methods of national income, that is the products method, the income method, the expenditure method. You will learn about the expenditure method, how the four factors of production contribute in terms of this income. And similarly, in terms of the expenditure method as well as that is the income method and expenditure method, you will consider consumption, investment, and the government spending functions. I'm sure you are going to learn it in a very interesting way. What are the issues in computing the GDP, the conceptual issues as well as the statistical issues, the concept of double counting, the the problem of collecting data and all these things we are going to cover up. And then the advanced version of that, the Keynesian model of national income, that is going to be important. Keynes was a very notable economist. His life he dedicated to the concept of income and employment and how this has been linked with the various parameters, aspects of the economy. That is going to be discussed. I'm sure Lokendra is going to cover it very well. And the two-factor model, three-factor, four-factor economic model is going to be covered. Further, you are going to learn the concept of investor and multiplier, the consumption function, savings function. Of course, if you understand the consumption function, savings function, it is very corollary to it. Similarly, if you understand the concept of MPC, marginal propensity to consume, I think it's very simple to understand what is marginal propensity to save. They are very much linked. Similar is the case with average propensity to consume, average propensity to save. I think marginal and average is something like the cricket, where maybe, 1 over back, there was the average of was so and so, and after the end of this over, the average is so and so. This is the runs scored in the last over is marginal. So it's very simple to link up marginal with average, and you are going to learn the concept of allocation function, distribution function, stabilization function. This is a part of your curriculum in this particular aspect. In public finance, you are going to learn some very interesting things, and public finance is a very, very crucial thing, friends, today when we are talking about how the government is going to revive this economy and what is the role of the government. So here comes the very important things of public finance. Like your father has to run your home, that is the personal finance, he is looking into this aspect. Similarly, how the nation is to be run, that is public finance. And in public finance, you are going to learn some very, very important things. You are going to learn something once again about the market failure, market power, and so many other things. Of course, incomplete information, externalities, and so many things are there. But you will have to understand, you will understand or rather appreciate the role of the government, how the government would intervene where the equilibrium situation is not there. Because we are, it's about a dynamic equilibrium. The factors keep on oscillating from one to other place. It's a pendulum. And how the direct and indirect measures of the government are there as an intervention. And fiscal policy. What exactly is fiscal policy? How the government collects the revenue? Where the government spends? What are the canons of collecting the revenue? What are the canons of the spending? Like the government has the canons of economy, of maximum social welfare, of authorization of the canons. So in terms of revenues, what are the major we can say sources of government revenue, and which sources should be tapped at what point of time? This is a very big gamut of fiscal policy. I am not going to the nitty-gritties of that because the faculty is already going to be there. I just wanted to introduce this subject. I just wanted to inject some energy in the morning. I just wanted to, discuss with you what is the importance of this subject. If you understand the importance of the subject, if you approach this subject with interest, I am sure the task of the faculty is going to be more interesting and easy, and that is what my effort is about. Believe me, friends, I repeat, this subject, once you take interest, it's a very small subject, the topics, once you try to understand the concepts, there are some 3-4 chapters consisting of some other sub-chapters. The chapters are like that. Once you develop the interest, thereafter, finally a single reading can also give you a recap of the entire syllabus. I repeat, this subject is very, very crucial, very important, very interesting from the point of view of your examination, from the point of view of education, from the point of view of the economy. And when you become chartered accountants, professionals, particularly in the field of finance, this subject is going to be a very, very important subject for you. This is what I wanted to just have some, interaction with you this way. I'm sure once again we have a very excellent faculty is going to cover up this subject in a very excellent way. I think I'll now pass on the baton to Lokendra ji for the details of the subject. Thank you.
Thank you, Mr. Chair, for such a nice introduction to the subject. I just hope that I'll be able to justice to the paper, expectations that you have in this paper. So, I think I can start now.
Please start, sir.
Okay, so good morning, everybody. So, as Mr. Jai has already said, this is a paper which covers the basics of economics. We will, in this topic, look at 4 dimensions of in this paper we have 4 topics. One is the topic about macroeconomics, then we have topic about public finance, then about money and monetary policy, and then we have the last topic on international economics. Before I start, let me just put things into perspective as to why we have these units and what we plan to do. I will be, for a large part, using MS Word for the lectures. The first part is macroeconomics. In macroeconomics, as you must have already studied in your school textbooks on economics, in macroeconomics, we look at the economy-wide aggregates. So we look at the behavior of the aggregate macroeconomy, total output in the economy, total consumption in the economy, total level of employment in the economy, overall tendency of prices in the economy, and so on. Now, while doing this, first of all, we need to understand as to how we measure the performance of the economy. When we say economy, if an economy is growing or economy is not growing, the employment is low, or the economic activity in the economy is going to a low level, high level, first we need to understand as to how we measure those variables. That is the first question. This measurement is covered under the first topic that we are going to start with today, that is national income accounting. That is the first topic. First, having looked at the issue of measurement of economy-wide aggregates, the next question is how are these variables determined? So, for instance, if I say that today, in this current year, the economy's GDP is going to be low, the question is why is it is low, and then is there some way through which the government can bring it up, the economy can be revived? In order to answer these questions, we need to understand the factors that determine the national income. And that is something that we are going to study in the next topic, title of which is Keynesian model of income determination. The next 2 topics, unit topic 2 and 3, are going to be about the government policy. As we will study government policy, we talk about fiscal policy and we talk about monetary policy. Before we come to the issues of fiscal and monetary policy, we will study some basics of this. So, for instance, when we talk about fiscal policy, we will see basic question: why is it that the government? Why is it that we need the role of the government in the economy? So we will start with that question. As Mr. Jai has already described very well, there are certain problems that would arise in the economy if the economy were to be left to its own, to the market forces. We will study what the different issues are that would arise in the absence of an intervention by the government. Then we will see how is it that the government can take care of these issues using the tools of government expenditure, government tax collection, government non-tax revenue collection, government budget deficits, government debt, etc. This policy of the government, the policy in which the government intervenes in the economy by changes in the taxes, non-tax tools of government revenue, government expenditure, government subsidies, government transfers, government debt, government deficit, etc. This is called fiscal policy. One policy tool that is at the disposal of the government. The other policy tool at the disposal of the government is the monetary policy. Before we come to the issue of what is monetary policy, we need to understand that monetary policy basically acts largely by affecting the price of obtaining funds from the market, that is the interest rate. And therefore, in order to be able to understand monetary policy, we need to understand how interest rates are determined. And we will see interest rates are determined by demand for money and supply for money. So we start by looking at what is money, what are the main theories of demand for money, and then by reviewing 3 or 4 important theories of demand for money, we will get some basic idea about the factors that determine money demand. Then we look at money supply, the basic idea of money supply and how the money supply is measured in India. As we will see, in India, the way we talk about money supply has undergone many changes from the period the Reserve Bank of India initially started publishing the money supply data in 1935 to today. Having studied money demand and money supply, then we look at determination of rate of interest. And then we look at how monetary policy is conducted, the practical issues pertaining to monetary policy. The last part is about international trade. Although this topic is titled International Trade, it is wider than that. When we talk about linkages of domestic economy to the rest of the world, we talk about broadly 2 types of linkages. A, linkages in terms of trade in goods and services. Okay? And the second is trade in assets, which we call the capital flows. Both of these types of trade have important effects on the macroeconomy. Okay? It will have implications for the model of income determination that we will study in topic 1. So we start by looking at the issue of what is international trade. Why do we need international trade? Okay? We will study 3 or 4 important theories. Start from the first theory that try to justify international trade. And then starting from that, we will look at some of the more recent theories, not the most recent one, but theories which were given up to 1950s and 60s, which cover the basic reasons why we have trade in goods and services across nations today, even though almost every country is capable of producing almost everything. Then why is it beneficial for the countries to engage in trade? Then we look at capital flows. Why is it that capital flows across borders? What are the different types of capital flows? And then we will see what are the problems with trade in goods and services and trade in asset, that is capital flows. Finally, there is a very important variable that arises as soon as we talk about more than one country, because every country has its own different currency. So when we are talking about more than one country, we need to talk about the price at which currency of one country can be traded for that of the other country. This is called the exchange rate of the currency. And this plays a very important role in international economics. Whether we are talking about finance or international trade, this variable plays a very important role. If you have followed the newspapers, you would have heard that recently it reached the level of the currency, the exchange rate of Indian rupee versus US dollar reached the mark of 75. So, what are the factors that determine this currency and how is it that this exchange rate affects the economy? Okay? Why are we so much interested in the fluctuations in the exchange rate? That is the next question. So these are the 4 topics that we are going to study in this topic. I would request you to pose a question as soon as we have one so that I can incorporate your questions. I have a few questions. I have a few questions I have received. First question is about the mark structure. I think the mark structure is given in your study material, and I think more light on this issue of mark distribution across topics can be thrown, I think, by people from the institute. So I would request the people from institute to please throw light on that. Second question is about what fiscal means. Fiscal basically means the issue pertaining to expenditure and revenue of the government. So when I talk about fiscal policy, I talk about the policy of the government in terms of government expenditure and government revenue. That is the basic idea of fiscal policy. Okay. There were 2 or 3 notes that there is disturbance in audio. I hope the audio is clear now. If it is still not clear, please let me know. Let me see what type of corrective action I can take. Okay, so with this background in mind, let's now start the topic 1, that is national income accounting. As I said, in national income accounting, we study the measures of national income, okay, and the measurement or accounting practices. First question is, why do we need to study this? Why do we need to study national income accounting? There are a number of reasons listed in your book, and I'll not go into details of all of that. I'll just highlight a few important reasons. I hope the audio is clear now. Please let me know if the audio is clear now.
Okay.
As far as notes are concerned, I am going to lecture through MS Excel, MS Word and MS Excel, and I'm planning to draw diagrams using MS Paint so that I can teach according to your requirements. So I do not plan to, as of now, I don't plan to provide any notes. There is a question regarding what is the difference between fiscal policy and monetary policy. This issue will be clear as we proceed further. For now, let me make the following statement very briefly. When we talk about fiscal policy is about the revenue and expenditure of the government. Okay, so if the government plans to intervene in the economy by changing tax on some commodities or some services, or by changing the expenditure of the government on some heads, we say this is the fiscal policy measure. On the other hand, monetary policy measure is about changing the interest rates, changing the money supply, which given the money demand changes the interest rates, and then it affects the macroeconomic variables. That is about monetary policy. Okay, I hope this is clear, and this will become further clear as we go through units 2 and 3. Then there is a question about usefulness and significance of national income. Now let me start with this question as to what is the usefulness and significance of national income. Why should we study national income? As I said, there are a number of factors listed in your study material. I'll not go into all of them. I'll just highlight 3 or 4 basic issues. First issue, national income gives you a measure of the size of the economy. When I talk about some economy A, first question that arises is, what is the size of the economy? How do I measure the size of the economy? So here the role of national income accounting comes into picture. So what I say is, we look at the total quantum of production of goods and services in that economy. Okay? That will give an idea about how large the economy is. So on the other hand, there is another dimension to this. If, as you have seen, larger is the scale of production in a given economy, larger is the amount of factor incomes being dispersed to the factors of production. When production is taking place, people are getting salaries, people are getting rents, people are getting interest payments because people must have lent to the producer for installing the plant. Okay, people are getting profits. So the incomes are higher in the economy when the scale of production is higher. So there is another way of looking at the fact that it measures the size of the economy. So that is one thing. Second, it gives us a framework in which we can understand the functioning of the economy. As we will see later in this lecture, when we talk about national income, we are talking about different types of expenditures. Consumption expenditure, investment expenditure, exports, imports, etc. And then we are looking at contribution to different sectors of the economy. And then we are looking at factor incomes being paid to different types of factors of production in the economy. So the national income accounting gives us a framework in which we can understand the basic functioning of the economy. A structure, it provides us with a structure. Third, it gives us, if we look at the distribution, so as we will see, we measure the national income using expenditure approach, using value added approach, using the income approach. If I look at the value added approach, I get an idea about the contribution to economic activity coming from different sectors of the economy. So for instance, we say in India, 15% is accounted for by agriculture. 25% almost is accounted for by, say, manufacturing. About 60% is accounted for by services. So we get an idea about the contribution coming from different sectors and also subsectors of that. And then when we look at the income approach, we look at the distribution across different types of factors of production. So we say the income that is being paid to different factors of production, what fraction of this income is going to profits, what fraction is going for interest payments, what fraction is going for, say, labor payment, etc. Okay? That is another thing. The data that we generate, so the data that we generate about the size of the economy, the unemployment levels in the economy, unemployment rates in the economy, level of output, price level, this type of data are useful for policy analysis, policy research, macroeconomic research. Based on, just as you, in order to understand to look at the variation in the health of a company, you look at the different parameters pertaining to finances of that company. If we want to understand the functioning of a macroeconomy, we trace the behavior of different variables pertaining to the macroeconomy. Over time, we juxtapose the data pertaining to these variables with other variables and try to see what are the problems. Well, as I said, I do not plan to, because I will be drawing diagrams and equations here as per the requirement as we proceed further. So I do not have any plan to distribute this. I don't know whether you will be provided recorded lectures or not. If not, then I would suggest you just try to draw them. But largely these diagrams and equations will be from your study material. So those are all there. I don't think you need to worry much about that. My request to you would be for here now try to understand what is being discussed here. And if you have any doubt in that, put a question right at that time so that I can try to answer it right there. Okay. So the other measures look at, as I said, to have the data pertaining to functioning of the macroeconomy. So for instance, if you look at now, you must be reading in the newspapers during last 3-4 days that, okay, the GDP in India in the quarter ending 31st of March was expected to be growing at this rate, but it has come down to this rate. During the next 3 quarters, the GDP is going to expect to grow at this rate. With the help of these data, government can understand the impact, government can gauge the impact of the current crisis in the macroeconomy. And then it can consider the type of action that needs to be taken in order to bring the economy back on track once the crisis subsides. So the data become important here. The other issue is about the membership of international bodies. As you must have heard, there are a large number of international bodies like the International Monetary Fund, the World Bank, the Asian Development Bank, etc. These bodies are run by the contributions from different countries. Okay, and these bodies provide help to different countries. The contribution that each country has to make to the running of this, as well as the entitlement of each country to finances from these bodies, depends to a great extent on the size of the economy. And here again, the data that arise from national income accounting become important. Okay, so I hope these are clear points regarding why the national income accounting is important to us. Okay, now let's look at different measures of national income. Okay, let's start now. As I said, national income gives an idea about the total amount of production and services in the economy. At the same time, it is total amount of income earned by factors of production in the economy. These are two different ways of looking at national income, and these correspond to two ways of measuring national income and also two measures of national income. Let me start with the most commonly used measure of national income, that is GDP at MP. Here, GDP stands for Gross National Product. This is the most commonly used measure. I'll come to the issue of MP in a short while. Let me first talk about what gross domestic product is. Gross domestic product is the market value of all final goods and services produced in the domestic territory of the country within the given period. Let's look at all these different things one by one. First, look at this issue of market value. Then we say all final goods and services produced in the domestic territory of the country and then within the given period. These are the four important things to know. Let me start with the question of market value. Why do we need market value? The basic idea is the following. When we are looking at a macroeconomy, we are dealing with thousands of different types of goods and services. We produce wheat, we produce rice, we produce, say, soybean, we produce soybean oil, we produce blackboards, laptops, computers, cell phones, books, markers, etc. A large variety of things. So when we are looking at the total amount of production in the economy, we cannot say that, we cannot give a long list of, say, 1 million items and say we have produced so much of each of these. We need a common denominator in which to measure all of them, and that common unit is given by money. How do we convert them into money? Obviously in terms of the prices. So here comes into role the issue of prices. As we will see, we have different types of prices here. We have, when I talk of prices in the economy, I can talk about market prices. That is the most readily available figure for you. For everything almost there is a market, and you can go to the market and check the price for that. Okay? That will give a realistic idea about the price at which it is being traded. Then we will also talk about two other measures of prices. But to that I'll come in a short while. So first issue is that since there are a large number of goods and services being produced in the economy, we need to talk about the market value. Second, all final goods and services. We need to talk about final so that we can avoid double counting. And to give you an idea, this is a very simple example of this is the following. Look at bread and look at flour and look at wheat. Farmer grows wheat, which comes to the flour mill, which converts it into flour, and this flour is then goes to the bakery, and bakery converts it into bread. If we buy, what you are consuming eventually is bread. But in the process, the bakery owner is using as an input some amount of flour. Now, obviously, it is what this flour has already been consumed in converting in making the bread. So it is not available to you as consumption. It is not, once it is converted into bread, it is no longer there, even though it was produced in the given year. Okay? So that is the reason, in order to avoid this double counting, we look at only the final goods and services. The other way of looking at it would be to count both flour and this, but then we do not look at the total value of bread, but we look at simply the difference between the value of bread and this, but this is something to which I'll come later. For now, it should be sufficient to note that in order to make sure that I do not count the same thing again and again, we just look at the final goods and services. By final, we mean the final use. If you are using this flour for making chapatis at home, then it will be a final good, because you are consuming the flour here. You are not converting it to something which is being sold. Okay? But if it is being used by a bakery, it is the bread which is being sold and not the flour. And that is the reason it is the flour. It is the flour is not used as a final production good. Another example is that of car and car tires. If a car manufacturing firm buys tires from a tire manufacturing firm, fits these tires into the newly produced car, then it is the new car which is the finally produced commodity, and not the good, not the tires. So in this case, the value of tires will not be counted as a final good, only the value of car will be. However, if these tires are being used for replacement, now then in that for replacement of tire in some old car, then the tires are being consumed. Then it will be the tire which will be counted. Okay, so that is other thing. Third is in the domestic territory. The idea is that when we talk about the GDP, the gross domestic product, it is the domestic that matters. The D stands for domestic. So we are looking at the production activity which is taking place in the domestic territory of the economy. Okay, but please note this domestic territory has two things. A, there are certain domestic factors of production giving services abroad, such as professors from Indian universities lecturing abroad, CAs from India doing practice abroad. The services are being produced in that country, but the factors belong to the domestic economy. The services of such CAs and such professors are not counted in GDP. Because even though they are producing some services, these services are not being produced in the domestic territory of the economy. Okay? In GDP, we just count those goods and services which are being produced in the domestic territory. Where it is being produced is important in domestic. Okay? At the same time, there are some production by foreign factors of production. Which is taking place here. They are producing here. Again, maybe some CA from UK is doing practice in some company in India. Okay, that CA is not an Indian factor of production. Okay, but the services that he or she is giving are being produced in the domestic territory of India. So it will be counted as domestic product of India, because the place where these services are being rendered is India and not UK, even though the factor of production belongs to UK. Finally, within the given period. You must have heard about stock and flow measures in your basic economics course. Stock and flow measures. Stock variables are those variables which are measured at a given point of time. Like we say total money supply. Money supply as of 31st of March 2020 is this much. This is like, suppose you have a water flowing into some bucket. If you are measuring the amount of water in the bucket, it will be measured at a point of time. So that's an example for stock variable. But if you are looking at the total rise in the level of water in the bucket, you have to talk about some period. We say the rise in the bucket, water level in the bucket during, say, last half an hour has been this much. So this is measured for a period of time. This is called a flow variable. We are talking about production taking place within some period. That is one important thing about the level of production. So GDP is a flow concept, and we are talking about the goods produced within the given period. Please keep in mind, when I say in the given period, it means only newly produced goods and services. Something that was produced last year but that is being sold this year will be counted to last year's GDP, not current year GDP. Okay, so any good or service will be counted only in the GDP of the year in which it was produced, not the one in which it was sold. Which also means, for instance, that the sale of second-hand goods and services is not counted. Okay, some car was produced this year, it was sold. It will be counted in this year's GDP. But you buy a second-hand car this year, the value of the car will not be counted towards this year's GDP. The only thing that will be counted for this year's GDP is the broker must have given some service in helping you purchase the car. And before the car was sold, the previous owner must have spent some amount in getting the car serviced, so that it is it's a good position. It's in a position where one would like to buy the car again. So that service is being done in this year. The broker service being given in this year, it will count in this year's GDP. But the car was produced some time back, so it will be counted in the GDP of the year in which it was produced. So this is the idea of GDP. Finally, gross domestic product. This is something to this gross. G stands for gross, to which I will come in a short while. So this is value of output, and as you will see, this is equal to the value added. One important point that I must highlight is there are certain non-market activities which do not go through the market, like household activities. These do not pass through the market. And therefore not counted in GDP. So for instance, the stuff that I am teaching here, it will be counted as GDP because it is going through the price mechanism. It is being sold, okay, to a particular institution. But if the same stuff if I teach to my son, it will not be counted as a part of GDP. Okay, so that is another thing. Now there are other measures. There are several different directions in which we need to diversify this discussion. First of all, let me talk about real and nominal GDP. As I said, this GDP can rise is the value of output at market prices. If you look at the GDP of a given country bit at two different points of time, it can rise due to two things. A, it can rise due to rise in value of output, and it can rise due to rise in value of prices. So as long as the prices are rising, the idea that you get about the value of GDP might be deceptive. So we need to separate. If you want to compare the value of GDP at 2 points of time, you need to separate the effect of change in quantity and change in prices. Okay, and this is done by the idea of real GDP. Let me give you an example. Consider an economy which produces only two goods, wheat and rice. Look at this column. In 2018, suppose this produces Q stands for quantity and P stands for price. Suppose in 2018, this country produced 20 units of wheat, suppose 20 kilograms, and 12 kilograms of rice. The price of 1 unit of wheat in 2020 was 20 rupees a kilogram. Let me raise the font size if it appears to be too small to you. I hope this is better now. So look at this. In 2018, the price of wheat was rupees 30 a kilogram and price of rice was rupees 60 a kilogram. Okay? And we know the GDP is simply market value. So market value of wheat in 2018 will be 20 into 30 is equal to 600, and that of rice will be 12 into 60 is equal to 720. Total is equal to 1320. So the value of GDP in 2018 will be equal to rupees 1320. Now let's look at the GDP of the same country in 2019. Suppose in 2019 the quantity of wheat rose from 20 to 30 units, 20 to 30 kilograms, and that of rice rose from 12 to 18. So 12 kilograms to 18 kilograms. And the price rose from 30 rupees per kilogram to 40 rupees per kilogram, and the price of rice rose from 60 rupees per kilogram to 80 rupees per kilogram. So for 2019, the quantity is this much, the price is this much. For rice, quantity is 18 and price is 80. In order to calculate the GDP of 2019, we will multiply the price of rice produced with the quantity of rice, that is 30. So we get 30 into 40 is equal to 1200. And here for rice, the quantity produced is 18, the price is 2009 is 80. So we get 1440. We total the amount we get 2640. If I want to find out by how much it has risen, you will note that it is 2640 is just double of 1320. That means the GDP in this country has doubled. That is the idea that we get by looking at the nominal GDP. This is called the nominal GDP. Excuse me. Nominal means at the current prices. Means at actual prices. But then this is misleading for the following reason. I have made this example simple by raising the quantity in the same proportion to keep the thing simple. Look at the quantity of wheat. It rose from 20 to 30. That means it rose by 50%. Quantity of rice rose from 12 to 18. Again, it rose by 50%. So the production level rose by 50%. But the GDP just became double. Why? Because the price has also doubled. From 30 to 40 and 60 to 80. So if we want to just measure the change in quantity and control for the change in price, what we do is we calculate the GDP at constant prices. So we keep the constant in some base year and calculate GDP for all years at those prices. So for instance, let me take 2018 as the base year. If I do that, what I'll do is, even GDP for 2019, I will calculate only at 2018 prices. So quantity is 30, price is 30, I get 900. For rice, quantity is 18, but price is, I take 60, base year price, I get 18 into 60 is equal to 1080. If I total that, I get 1980. And you may note, 1980 is 50% higher than 1320. So this GDP, which I calculate by keeping the prices constant, gives me the real idea about the variation in output produced. And that is called the real GDP. I hope the idea is clear. Let me look at the questions in between. First question is, what is the CSO? What is the measure of national income? Basically, national income, we look at the total income. There are different measures. We look at national income, we look at personal income, we look at personal disposable income. I'll come to all these measures in a short while as I proceed further. So I would request you to please wait for a while. The next question is, what is the composition and structure? Yes, we do look at composition and structure of GDP using different approaches. I'll come to that. Fiscal policy, monetary policy, international trade policy. These topics will be clear as we proceed further. So very brief, monetary policy is framed by the central bank. Fiscal policy is framed by the Ministry of Finance. And then international trade policy by the different agencies under the government. Then there is a question as to flour becomes a final consumption good at home, and that's why it is included. And for bakery, it's an intermediate good. It's not included. Yes, for bakery does not. The flour that goes to bakery is not used for final production, for final consumption. Bakery converts that flour into bread, and that is used for final consumption by you. So that is the reason the part of flour that goes to bakery is counted as an intermediate good and not as a final good. But the flour that you bring home, of course, you make chapatis with that, you make bread with that, but you do not sell that in the market. You use it for personal consumption purposes. That's why. Okay. Of course, if the same flour is going to say some restaurant, then it will not be counted as a final consumption, final good. Okay. Then there is a question. Yes, domestic factors giving services abroad will not be part of GDP, because for GDP what matters is the place where the production is taking place. Even though these factors of production belong to India, the production by them is not taking place within the domestic territory of India. The production by them will not be counted as GDP. What I'll do is that I'll finish one topic and then I'll take the questions from that. I think that will be better, so that will not disturb the flow of the discussion. So let me very quickly discuss the nominal versus real GDP. As I said, GDP is measured at market. We are looking at GDP being measured at market prices, and GDP can rise even if the prices quantity remains constant, because the prices are rising. So in order to just focus on in order to measure the rise in quantity produced, we look at the GDP measured at some constant prices. That is the idea of real GDP. As I have said here, suppose in 2018, the quantity produced is this, the prices are this. In 2019, the quantity produced is this, and the price is this. We'll get these different quantities. Okay, but as you see here, even though the quantities rose only by 50% each, the GDP just became double. Okay, so this is happening because the prices are also rising, and therefore, in order to focus on the quantities alone, we measure the GDP at the fixed prices. As I do that for 2019, I get this value, and you can see this shows that the GDP has risen only by 50%. Just as we saw here. Okay, so that is the idea of real GDP. Real GDP means GDP at constant prices. That means we look at GDP at some base year prices. Okay, finally, let me talk about one important measure, that is called GDP deflator. GDP deflator is nothing but nominal GDP by real GDP into 100. This tells us the percentage change in price level. So for instance, if you look at this example, you will see that prices have risen from 30 to 40. That is about 1/3. Here 60 to 80, about 1/3. And if you look at the ratio of nominal to real GDP, this quantity divided by this quantity, you get 133.33. That is 33% rise. Okay. So this gives us an idea about the average rise in the prices. Now let me quickly go to the other measures, because I think of course we need to cover a large number of topics. What I'll do is that I'll first cover all the measures of GDP, and before going to the methods of measurement of GDP, I'll take your questions. And then, having covered the methods of calculation of GDP, I'll come again to the questions. The next issue is that of gross national product. Gross national product, please note GNP is gross national. That is, it is the domestic factors of production. Okay, so please note GDP is produced in the domestic territory. And GNP is about produced by or belonging to the home country. So there are several factors of production belonging to the home country who are producing, but they are not producing in the domestic territory. They are producing abroad. Their contribution to the production will not be counted as domestic country's GDP. It will be counted in the GDP of the country where they are producing. But it will be counted in the GNP of the home country, because the factors of production belong to the home country. Similarly, the production contributed by the foreign factors of production in the home country will be counted in the domestic country's GDP, but it will be counted to the foreign country's GNP. So that is the idea. GDP says the production taking place in the domestic territory. Gross national product means production taking place by the nationals, the factors of production belonging to that country. What is the difference between the two? Please note, if we want to go from GDP to GNP, we need to do two things. A, we need to add the contribution to production by our factors of production who are working abroad. Okay, or the way to measure it would be to get the factors income abroad. Factors incomes earned by domestic factors of production producing abroad. At the same time, the domestic GDP of the home country includes contribution to the production by the factors of production working in the domestic territory. So we need to subtract their contribution because it does not belong to our GNP, even though it belongs to our GDP. So we can say GNP is equal to GDP plus factor income from abroad, factor incomes paid to our factors from abroad, and we need to subtract factor incomes paid to foreign factors of production for producing domestic territory. This thing, factor income from abroad minus factor income abroad. This is called net factor income from abroad. NFIA. It should be clear. GNP is equal to GDP plus NFIA. GNP is the other measure. So basically, whenever we are moving from national to domestic, domestic to national, in order to get the national product, we add NFIA to the domestic product. That is the other thing. So this, accordingly, if I subtract GDP from GDP at market prices, I subtract NFIA, I get GNP at market prices. Next is issue of gross versus net, as we have already studied in your, I think you know it very well. Gross includes even the amount that goes for depreciation is included in gross. If we want to arrive at net, we need to subtract depreciation from gross. So, for instance, GDP at market prices minus depreciation, this gives me NDP at market prices. Similarly, GNP at market prices minus depreciation, I get NDNP at market prices. So this is the other thing. The next issue is that of different types of prices. As I had said, we talk about market prices and factor cost. We need to understand the difference between the two. Because please remember, when we are looking at income to the factors of production, national income, we are just looking at incomes to factors of production. That is the idea. But market price is more than that. And in order to understand why it is different, let's focus on the following. Suppose there is a producer who produces something. In producing that, suppose by paying to all factors of production, to the labor that he or she hires, his own profit, the interest that he or she pays on the loan that he has taken to install the plant, the rent, all these things together, suppose the person spends 1,000 rupees, suppose. But then there are indirect taxes worth rupees, say 200 to be paid on that. And then the government gives a subsidy on this product of the rupees 100. So what is the market price? The factor cost is rupees 1,000. Obviously, this 200 rupees will be added to the factor cost to calculate the price that will be charged in the market. But the government is also giving a subsidy of 100 rupees. So the price will be lower by this 100 rupees. So market price will be equal to 1,000 plus 200 minus 100. In general, we can say market price is equal to factor cost. Factor cost basically means remuneration to factors of production. Factor cost plus indirect taxes minus subsidies. If you look at these together, indirect taxes minus subsidies, this term is called net indirect. So you can say market price is equal to factor cost plus net indirect taxes. In general, we say MP is equal to FC plus NIT. And therefore, we can say G, and we have already seen NDP at market price, and DP at factor cost will be equal to NDP at market price plus minus net indirect taxes. Similarly, we have seen net national product and NP at market price we have already seen, and in order to arrive at NNP at factor cost we need to subtract NIT from NNP. So NNP at factor cost is equal to NNP at MP minus NIT. Okay, now look at what this NNP gives me and what this NDP gives me. NDP at factor cost is the payment to factors of production for the production that is taking place at home. This gives me simply factor income for production place in domestic. And look at an NPFC. An NPFC includes the payment to the factors of production for the production taking place in the domestic territory plus NFIA. So that means it gives me the total income of domestic factors of production, and this is called national income. Okay, so what is national income? National income is the total amount received by the domestic factors of production for contribution to the production activity, and that is equal to NNP at FC, net national product at factor cost, which we get by subtracting the net indirect taxes from NNP at market prices. Okay, how do we get NNP at market prices? We get NNP at market prices by subtracting depreciation from the GNP at market prices. And how do we get GNP at market prices? We get GNP at market prices by adding net factor income from abroad to the GDP at market prices. The other way of looking at would be NNP at factor cost is equal to NDP at factor cost plus NFIA. That is the other way of calculating the national income. NNP at factor cost is equal to NDP at factor cost plus NFIA. That is the other way of looking at it. Then this is the national income. There are at least three other measures that we need to look at. First, let's look at personal income. This national income includes certain types of income which accrue to the people by way of their production to the contribution to the factor to the production activity, but it is not actually received by them. Okay, one example of this is, for instance, a social security contribution. Suppose there is a person whose wage is, let me say, rupees 1000 per week. Okay, but out of this 1000 per week, the employer deducts rupees 100. This rupees 100 is contributed to his or her pension fund by the employer. So this 100 rupees is a part of the income which is actually earned by that person. This is earned by a factor of production but not received. So in order to arrive at the personal income is the actual income received. This actually is the income received. So in order to arrive at personal income or PI, from national income we need to subtract the income earned but we need to add income which is received, but this includes, there are certain types of income which are received but these are not earned. Please remember when we talk about national income, which include factors, incomes. That means the incomes that you get as a factor of production. Factor of production means you are contributing to the production process. But then there are certain types of income which you get not due to your contribution to the production process, but just government does it otherwise. We call the transfer payments, like say pensions, unemployment allowances, okay, old age pension. So this is the type of income transfer which happens not due to the contribution in the production process. That means it is not a factor income, but it is given to you without having earned the income. So you need to make these two adjustments. Okay. The other example of income earned but not received is the undistributed profits. The undistributed profits are dividends you receive, but undistributed profits are kept by the corporate. So these do not reach the individuals. Okay. So this, if you make this adjustment, subtract income earned but not received, but add income received but not earned to the national income, you get personal income. Finally, this personal income is not completely available to the individuals for making purchases. Government levies direct taxes on that. And if we subtract the direct taxes, we get the amount which is available to the individuals for making purchases or saving. That gives the personal disposable income. For disposable personal income. For disposable personal income, the DPI is equal to personal income minus direct taxes. This disposable personal income is something that you can either consume or pay. Okay, so that is it. Finally, let me look at one more measure of per capita income. Two countries may have same levels of national income, but their populations may be vastly different. If you want to have an average idea about the income earned per person in the economy, we need to have an idea about the per capita income. This is equal to national income divided by population. Okay, this is called the per capita income. So suppose the country's national income is 1000 and the population is, let me say, 200. The per capita income in that case will be 50. Okay, so these are the different measures of national income. Next, we look at the methods of measurement of national income. Let me first look at the methods of measurement of national income, and then I'll take the questions together at the end of the. If there is an urgent question, then I'll, in the sense that which needs to be explained so that you can understand the rest, then I'll. I think I'll take these questions at the end of the session, so that for now we can, what I'll do is that I'll keep the last 30 minutes of the session reserved for questions and answers. So I'll lecture roughly till 9:30 or 9:35. And in the remaining 1 hour, I'll take half an hour or 20 minutes, I'll take questions so that we can, I can answer all the questions at the same time. It doesn't disturb the flow of the class. Okay. Fine. Now let's look at methods of measurement of national income. In order to understand the methods of measurement of national income, by the way, before I go into this, let me also introduce the idea of basic prices here. We have talked about factor cost and market price. There is another price called basic prices. Now we have a new concept called basic market. basic price. Starting 2015, the Government of India, like most other governments in the world, are publishing data only at market price and basic price, not at factor cost. So factor cost used to be used till 2015, but after that it is gradually being discontinued by all the countries following the directives of the United Nations. Let me look at what basic price is. We have seen that the market price and factor cost differ by the net indirect taxes. Okay? Indirect taxes can be categorized into two categories. One is the production taxes, other is the product taxes. Similarly, the subsidies can be bifurcated, can be categorized into two categories. One is the production subsidies, other is the product subsidies. Okay, the difference of basic price arises due to this. Indirect taxes is equal to production taxes. These are levied on the process of production and do not depend production and product taxes. These depend on the product. The product taxes are levied on the product and therefore depend. So one is the production taxes, other is product taxes. If you want to understand, look at the examples of this. Suppose you want to install a factory in, say, Noida, and you have to pay some taxes to the local authorities for starting the process of production, for installing the factory. Okay, please note, once this amount is paid for installing the factory and starting the production process, it does not say that, okay, you have to produce only 10,000 units or 20,000 units. Okay, or that if you are producing 20,000 units, you have to produce this much, you have to pay this much. For 20,100 units, you have to pay this much. It is not generally like that. So as a result, what happens is it's levied on the production process, and it does not depend on the quantum of production. It is called production taxes. And then once you produce the output, you pay product taxes on the output. So there are taxes being levied on the every unit of output being produced, like GST. Okay. Factor cost does not include either of them because both of these are indirect taxes. Market prices include both of them because they are indirect taxes. Okay. Basic prices lie in between. It includes production taxes but not product taxes. Number one. Number two, just as we have production taxes, we also have production subsidies. So in order to look at net indirect taxes, we need to look at net production subsidies, net production taxes, and net product taxes. So if you have basic price, factor cost, plus net production taxes, you get basic prices. And then to basic prices, you get net product taxes, you get market prices. This is the important one. This is factor cost plus net production taxes, basic prices. To basic prices, you get net product taxes, you get market prices. There is one more way of looking at the basic price. When the output is being produced, what costs are incurred? Or what is the price? What is the price when it arrives at the factory gate? The amount that has been paid. What has been paid? A, the amount to the factors of production. And B, the taxes which are levied on the production process, net of the subsidies. So it includes factor cost plus net production taxes. This is the price that exists at the factory gate. And then tax is levied on per unit output. That gives the market price. Okay, so that is the other thing. Coming to measurement of national income, first we need to understand one important thing. that there are three equivalent ways of looking at production. A, you are producing. You are producing output. Production of goods and services. In producing goods and services, you are hiring services of factors of production. So you will make payment to those. So leaving aside the taxes for now, it can be clear whatever production you are doing, final output, that is equal to the payment to the factors of production. Okay, so national income. So that is sum of factors income, sum of which is called the national income. And when you receive this national income, you spend this. Okay, either you spend directly, consumption expenditure, firms borrow from you and make investment expenditure, government collects tax from you, government spends, government expenditure. Okay. But there are different types of expenditure incurred on this output. Okay, and when you are spending this much, since you are spending this much, there is a demand for this output, production takes place. So it should be clear, production of goods and services by different forms will be equal to total factory incomes, will be equal to expenditure. Accordingly, we get three different methods of measurement of national income. This gives us the production approach or value-added approach. This gives us the income approach, and this gives us the expenditure approach. Production or value-added approach gives us the contribution of different sectors or subsectors to the GDP. This gives us distribution to different factors of production. And this tells us how output is disposed. You are buying, suppose the same, you are buying something, how that is being used. Okay, the same commodity can be used for consumption by you, the same commodity can be used as investment by the firms. Okay, so how much is being used as investment by the firms? Okay, is the issue, and how much it is being taken by the government, how much is being used by the consumers. So these are the three different approaches. So this highlights the contribution of different factors of production, the production units, this contribution of different factors of production, and this how it is disposed. Let me first look at the value-added method. Value-added method or the production method. In production method, what we do is we look at this according to value-added method, the GDP is equal to sum of value added by different production units. We club the different production units according to the sector or the subsector. So we club the different units according to different subsectors. Then we total the sum up the contribution, the value added by different subsectors to arrive at the value added by the entire sector. And then we arrive at the value added by the entire economy by adding the value added by all the sectors. So this way we get GVA at market price. This is simply gross value added market price. Gross value added at market price gives us the value added at market price by different sectors. By the way, this value added market price is primarily calculated at basic prices, and then as we add net product taxes to that to arrive at GVA at market prices. So I can say GVA at basic prices plus product taxes and this gives me GVA at market price. If you are giving GVA at basic prices, we have to add net production tax, net product taxes to that to arrive at GVA at MP, which is nothing but your GDP at MP. We have seen. If you still want to understand it, let me give you a simple example. Suppose there is a farmer who produces wheat worth rupees 1500. Then the flour mill owner purchases this rupees 1500 worth of wheat to have flour worth rupees 2000, and the bakery purchases this 2000 rupees worth of flour to produce bread worth which is sells rupees 3000. Now the total output that is coming out of this process is final output is rupees 3000. So if you look at the total product, it will be 3000. The other way would be to look at the value added. Value added by the farmer is rupees 1500. Value added by the flour mill is value of its output, that is 2000, minus value of its input, that is 1500, that is equal to 500. And value added by the bakery is the value of its output, that is equal to 3000, minus value of its input, that is equal to 2000, that is equal to 1000. So gross value added will be equal to gross value added by the farmer, that is 1500, plus that by the flour mill, that is equal to 500, plus that by the bakery, that is equal to 1000, which gives me 3000. And this is the total expenditure on this bread, that is 3000. So this domestic product, GDP, is equal to gross value added. So this is how we look at the gross value added. In India, this gross value added is computed for, if you want me to show you the different sectors that the government of India uses, let me show you this document. This is released by the Central Statistics Office of the Government of India. This is the latest document in this category. It is the GDP estimates for 2019-20 released on 28th of February. So we get it at agriculture, forestry and fishing, mining and quarrying, manufacturing, electricity, gas and water supply. So there are 8 sectors for which the government of India publishes the GVA data, and the GVA at basic prices is then sum total of this. So if you look at the 1920, the GVA at market prices is this much rupees crore. So rupees this many crore is the GVA at market prices, out of which agriculture is accounting for this much, mining and quarrying this much, services this much. You can see the largest chunk is coming from either manufacturing or financial, these services. So this is just to show you that using GVA, the GVA approach gives us the contribution of all these different sectors, which are arrived at by summing up the contributions to the GVA by the different subsectors within the sector, which in turn is arrived at by adding the GVAs of different units in that particular sector. Okay? So that is the idea of GVA. Next question is, how do we arrive at national income from this? Let's do this exercise because it will be further practice. The value added approach gives us GVA and market price, and we need to arrive at national income is net national product at FC. So what do we do? Please look at this. This is something that I leave to you, but please note what are the adjustments that we need to make. First adjustment is we need to go from gross to net. So what do we do? In order to arrive at gross from net, we subtract depreciation. So GVA at MP minus depreciation is equal to GVA at net value added at market price. Okay. Then once we have net value added market price, we need to look at net national product. Okay, so we need to add NFIA, NVA at market price plus NFIA is equal to NNP at market price, and finally we need to arrive at NNP at FC, and we do NNP at market price minus net indirect taxes is equal to NNP at FC. That is equal to your national income. Okay. Now, the question is, what do the firms, where does this value added go? Please note what is value added. Value added is simply the value added is simply value of output minus value of input. This is equal to the factors of production. So this value added will go towards payment to the laborers in terms of their wages and salaries. It will go for payment of interest to the person from which the firm had borrowed in order to smoothen the production process. Okay. Then it goes to the person as the owner or the entrepreneur as the profit. So it is sum of all these. So basically it is equal to factor remuneration. Okay. And this brings me to the next method, that is the income method. In income method, we simply look at the total remuneration to the factors of production. So as we have said, this NP at FC is equal to the total remuneration by domestic factors of production. Part of this comes from production process abroad, NFIE, and part comes from domestic. So let me look at NDPFC. First we look at NDPFC and add to that the contribution by the foreign factors of production. What does it include? It includes the following. It includes A, compensation of employees, which means their wages and salaries. Then labor is one factor of production. Other factor of production is when we talk in microeconomics about factor of production, we talk about land, labor, capital, and entrepreneurship. So we have labor, we have compensation to employees, then we have rent being paid for the natural resource which we call land. Then we get interest to capital, and then we have profit to the entrepreneur. These three things taken together, rent plus profit, this is called operating surplus. Okay. This is the other thing. Then there is something called mixed income of self-employed. We need to understand this term slightly carefully. We have said the factors of production can only be four: land, the way we have studied in microeconomics so far, land, labor, capital, and entrepreneur. And we have taken care of all these. Compensation to employees, that is wages and salaries, takes care of labor, and operating surplus takes care of rent, interest, and profit. This is for land, this is for capital, this is for entrepreneur. Okay. Where does this come from? Mixed income of self-employed. This is a category dominant mainly in the developing economies. And the reason is the following. There are many instances in which the single person contributes everything. Like look at a single practicing CA. The person is himself hiring his own office. The person is himself giving the labor. He is himself the entrepreneur. Okay. In that case, if you look at the total total income of the person, it is difficult to disentangle the part of income that is coming due to his labor, the part of income that is coming due to entrepreneurship, the part of income that is coming due to the capital that he has employed. So it is difficult. So in order to take care of this type of instances when the same person contributes everything, capital, labor, entrepreneurship, everything, we have a category called the mixed income of the self-employed. Okay, these three things, this and this, pertaining to the domestic factors of production, the production activity taking place at home. So this gives me NGDP at factor cost. At factor cost. But if I'm looking at national income, I'm looking at nationals' income, income of Indian nationals. And therefore, what I need to do is, I need to add to this net NDP at FC. I need to add NFIA NDP at FC plus NFIA. This gives me NNP at FC. This is my national income. So here I get an idea about where the factors where my total income is going. Okay. Finally, we look at the expenditure method. Hello, was someone trying to say something? Okay, finally the expenditure method. This expenditure method is about different uses to which the output is put. Disposal of total output being produced. Disposal of output. The main categories are the following. One is the private. This is the expenditure made by households. Expenditure by households. Please note this consumption expenditure. This is something that you are using for consumption, not for further production. So that is the key here. Okay. This is one thing. Then we have government. The expenditure in running the government. That is the government final consumption expenditure. Okay. Government provides several services, as you know, defense, internal security through police and other forces. And then government provides education. Government provides health services through government hospitals and dispensaries. All these for running all these services, government needs to spend on goods and services. Okay, that is called government final consumption expenditure. Okay, even the expenditure incurred by the government for any body under the government will be expenditure under this head. Okay, and this is usually calculated by looking at the total spending on this. Okay, so that is the other category. Then we have gross domestic capital formation. These acronyms are also, you will get to see them in the publication. So this is called PFCE, this is called GFCF, expenditure, this is called GFCF. This includes many terms, as you must have already studied. This includes, like, for instance, fixed capital formation in plants, etc. Fixed capital formation, then residential investment, units meant for housing purposes. Then it includes expenditure on acquisition of valuables such as jewelry, etc. Then it includes expenditure on changes in inventories, changes in inventories is basically the amount that you produced but did not sell. Okay. You are producing something but you are not able to sell it due to whatever reason. Okay, it will be added to inventories. Please remember, when we had talked about the definition of GDP, we had said GDP for the current year includes the value of output which is produced in the current year, even if it is not sold in the current year. At the same time, if there is some output which is sold in the current year, but it was produced in the last year, will be counted as the GDP of the last year. Okay. Then how do we deal with this? It was produced last year, it is being sold this year. We say it was added to inventories last year. Similarly, if we are, so inventory, I think I don't need to explain in more detail because you know it very, very well. All I would say is change in inventories could be negative, it could be positive. If the inventories at the end of this year, this period is more than the inventories at the end of the last period, we say inventory investment is positive. You add it to inventories. On the other hand, the inventories at the end of this period is less than the inventories at the end of the last period. That means you have run down inventories. You have taken from your inventories. That is called when we say inventory investment is negative. Change in inventories in that case is negative. Okay. So all these four are under the capital formation. These four, 1, 2, 3, 4 capital formation. The last amount is net exports. Net exports. Look at what can happen to the output that we have produced. It can be used either in the domestic territory or it can be sold abroad. We can say it can be exported. So that is the idea of exports. So we have used, suppose we have produced 1300 units. Out of the 1300, the 1100 units have been used at home by the consumers through consumption expenditure, by the firms through investment expenditure, by the government through government consumption expenditure. And then 200 units, suppose, have been exported abroad. Okay. But then please note that when we are looking at an economy which is engaged in the trade with the rest of the world, just as we are exporting a part of our product to other countries, that means the spending that our people do, our consumers, our firms, our government, a part of that spending falls on the foreign goods and services. So the total consumption is not consumption of domestically produced goods, but a part of this is the consumption of the domestically produced good, foreign produced goods. Similarly, the total investment by the firms, not the entire investment, is taking place through the goods and services produced in the domestic territory. A part of this is also taking place through the goods bought from abroad. So if we want to look at the total income of GDP of the country, we have to add exports and subtract imports. Okay, so we can say this is called the net exports. So there are three different approaches to GDP. Just to show you how Government of India looks at it, the expenditure approach. Let me show you this snapshot of the document from the MOSPI. This is how the Government of India does it. PFC, private final consumption expenditure, is this much. GFC is this much. GFCF is this much. Changing stocks, valuables. So this is consumption. PFCE, this is government expenditure. These three are components of investment. And then we have exports of goods and services minus imports. Okay, look at this entry, discrepancies. This is also very important. See, we have talked about three different approaches. We have talked about the income approach, we have talked about expenditure approach, and we have talked about the value added approach. The data on the components of for the three approaches are calculated by different statistical agencies. And please remember, we are talking about the macroeconomy, large number of units. In many places, the values have to be estimated. That means from little information, we have to, for information about fewer units, we have to estimate the contribution of a larger number of units. So given these complications, it is possible, and it does happen invariably, that the figures from the three do not match. There is some discrepancy minor. That is the discrepancy. So this is what it is. Okay, and just to give you an idea about the rates to GDP, as a percentage of GDP in 1920, the figures that were estimated till February, 60% is consumption expenditure, 11% is government expenditure, 27% is capital formation, out of which these are the three components. So these are components, and then we have this is fixed capital formation, fee, and then there is, and then exports 18%, imports 21%. So net exports is roughly 2.5%. Okay, so this is the. Let's quickly go back to the institutional framework. For India, the figures are calculated. The GDP data compiled by the national accounts of the CSO. CSO is the Central Statistics Office. Under the Ministry or under the Government of India. The guidelines for these are provided by something called the System of National Accounts by United Nations. So this is SNA is what it is called in brief. This gives the guiding principles for compilation of national account statistics in all the countries in the world, so that the figures that are there are standard definitions of each of the macroeconomic aggregate. Okay, so that the data from all the countries can be compared. The SNA 2008 had certain particular recommendations for due to which the data were revised. The NAS data were revised by the Government of India in January 2015. Okay. We now have 2011-12 as the base year. We have spoken about the real and nominal GDP, and we have seen that the nominal real GDP is the GDP calculated at the base year prices, constant prices. 2011-12 is what is used at the base year these days. in the national income and national account statistics data, constant prices. Okay, these are the minor factors. The other technical details I don't think I should be discussing in this course here. These are technicalities about into which we cannot go at this stage. As far as the states are concerned, states calculate their own data, GSDP, gross. So all the states have directorates of economics and statistics. So these, for different states, these directorates calculate data for GSDP and NSDP, and using the adjustments that we have seen for the GDP and MP, arrive at the measures of state income, state incomes. One important point is that of supranational sectors, like say railways or telecommunications. We are making a call. I'm making a call sitting in Uttar Pradesh to say Delhi or Rajasthan, for that matter. So where it will be counted, or suppose I take a train, you take a train journey, you board the train from Mumbai and get on at Delhi. So these are supranational sectors, the sectors which sort of are not confined to any particular state. So to which state does this contribution go? The contribution of the GDP in these sectors is calculated by the CSO, the same agency which compiles the data on national economy-wide aggregates, and then it is divided into different states according to some principles about which I can. Okay, finally the limitations of the national account statistics. First issue is that it does not give idea about the distribution. We have seen the GDP data, the national income data, give us an idea about I was looking at questions and I just found that some of you were not able to see the screen for a reasonable amount of time. I would suggest that you, in the meanwhile, just highlight that part which was explained when the screen was not visible, so that I can go over that once again. I'll discuss the limitations of the national account statistics in these 4 or 5 minutes. So please quickly write the topic that I need to explain, so that before proceeding to the next topic, I can come to that topic. Okay. Questions, as I said, Or maybe after I discuss limitations, I can take your questions also before I proceed to the determination of income. Okay. So distribution of income is something that is not reflected in the national account statistics data. If you look at the national income, it gives us the national income aggregate for the entire economy. And if you want to have an idea about the per capita income, we simply divide the national income by the population. Okay, but that is an average, and the problems that arise with the averages still persist here. Look at a situation where this is. I'll give you an example. Two economies, A and B. In economy, there are three individuals. In economy A, there are three individuals whose incomes are rupees, say 2,800, 100, and 100. Okay, in economy B, there are three individuals whose incomes are 1,000, 1,000, and 1,000. You may note the GDP in the total national income. So in the three cases will be equal to, per capita income will be equal to 1,000 in this case. Okay, but look at the income distribution. Here the distribution is equitable. And here it is highly skewed. Okay, this one person accounts for more than 90% of the income of the country. Okay, so these distributional issues are something that are hidden when we are talking about the GDP, number one. Number two, quality improvements are not seen. And I think the best example for you now could be that of a cell phone. Today, if you are buying a cell phone, in a cell phone just for rupees 5,000 or 6,000, you can get a large memory. You have several good functions like playing videos. You can even download movies and play movies. You can make these calls on apps such as Blue Jeans and Zoom. Okay, but look at the cell phones that you were able to buy for the same 5,000 rupees, say, let me say in 2001 or 2. These simply allowed you to make calls and send text messages, nothing else. They had black and white screens. Okay, no touch screen, nothing. Or take the example of computers. Today, if you want to buy a good machine, you can easily get a good machine with a very fast process for rupees 35,000 or 40,000 rupees. But if you talk about the machines which were used in say early 1990s, a machine which had just a Pentium 386 processor would cost you somewhere close to 70,000, 80,000 rupees. These would have RAMs like say just 250 MB hard disk and just 4 MB RAM, something like that. Okay, so you can imagine the speed. Okay? These quality improvements are not reflected. All we would say is GDP. In GDP, the contribution of that computer was 75,000 rupees. The contribution of this is 40,000 rupees. So it is much less as even if we ignore the prices changes, the contribution of this computer is just a half of that computer which one would buy in say 1991 or 92. But if you look at the speed, the performance is many times better. These are not reflected in the GDP measures. Then activities which are hidden. These hidden could be due to evade taxes or because these are illegal. Think of two individuals. One is teaching, suppose the same set of lectures. One person is taking the lecture in the C Institute, same amount being charged, same topic being covered. But that will be counted as GDP because that is being reported. The other person is not reporting this. Maybe the government machinery is not able to capture that. Suppose the person is taking the tuitions, so teaching the same stuff to a student at home. Okay, that is not being reported. Maybe the person doesn't want to report that as a part of one's income, so that one doesn't have to pay tax on that. So the same activity, but on that tuition, if the person is not reporting, the tax is not being paid, that amount is not being reported, it is not being counted as GDP. But the same lecture, same topic, same duration, same amount being charged, being reported, maybe because it is being delivered at an institute, then it will be part of GDP. Then there are illegal activities, obviously, which cannot be reported, and therefore it's not a part. It's So, given these two, it should be clear that the total amount of production activity in the economy and therefore income earned in the economy is much different from what is actually reported and therefore reflected in the GDP. Then there are items which are not marketed. Like household work. Household work obviously is not is not marketed. If the same work is being done by some servant or some maid, that is a part of GDP. But if the same work, instead of leaving that amount, if instead of hiring a maid or a servant, I do my household work myself, that work will not be counted as GDP because that is not being marketed. Okay. Then it does not distinguish between good and bad. Suppose some country has very bad law and order position, and therefore it has to spend heavily on police. Okay, so otherwise there is a country which is exactly similar to this country, but law and order is much better, and therefore this country does not have to spend on hiring police or hiring security personnel. Can we say that the country which doesn't have to spend on security is worse off just because the GDP is less? Okay. Obviously it is not, but if you go by the GDP data, it is worse because GDP will be less in that country. So that is another problem. Then the type of goods are being produced. Suppose there is a country in which the incidence of tobacco use is very high. As you know, tobacco use, as is seen by the government advertisements, etc., has severe negative consequences for an individual's health. So there is high use of tobacco, which on one hand you are buying tobacco products, it is being reflected in GDP. And then due to these health problems, you have to avail health services. That is a part of GDP. So GDP is being raised in two ways here. A, your purchase of the tobacco products, and B, your purchase of the health services. Obviously, this does not reflect that the country is necessarily better. So I think these are the main criticisms of GDP. There are other issues which are highlighted at the end of the chapter. I had said that I would take the questions at the end of the session, but I think it would be better for you if I take the questions before I proceed with the next topic, that is income determination. But before that, I think some of you did not have the video clear in between. So let me first take those questions which they missed, and then I'll take all the other questions. I hope this is fine. If this element is not fine, please let me know what should be better in your opinion. Well, by looking at the posts by you people, I can see that the video was not visible for almost entire discussion of the income method and part of the discussion on the expenditure method. Let me very quickly go through it once again so that it is clear to all of you also. See, let me go back to the question of value added so that you can relate to that. When we say value added is simply the difference between the output that you are producing minus the input that you are taking in. That is the value added. Where does the value added go? What is the value addition? Value addition is obviously the contribution that the factors of production that you are employing. So this value addition will be going to the factors of production. Okay, that is one thing. What are the factors of and that is precisely what the income method does. What is the income method? Income method looks at the contribution of GDP, the GDP, in terms of the contribution of different factors of production. So in value added method, what we are doing is we are looking at different production units and we are looking at their contribution. But this value added by different production units is also going to factors of production. So one way would be, instead of looking at these production units, we look at factors to which this is going. And this is what we do in the income method. What are the factors of production that we employ? We employ labor, we employ land, that is the natural resources, we employ the capital, and we employ the entrepreneurship. To laborers, we pay wages and salaries, or we call the compensation to employees. Then to the natural resources, we pay rents and royalties. To the capital, we pay interest, and to the entrepreneur, we pay profit. So we get compensation to employees, and these three are taken together collectively. These are called operating surplus. Let me highlight in different colors so that this is called operating surplus. So we can say this is compensation to employees plus operating surplus. Plus, there is third thing, mixed income of self-employed. There are many units in which the single person is doing everything. Same person employing his or her own capital to open an office. Okay, the same person is providing labor there. And what are profits or loss are there? The same person is taking care of that. So, at the end of the period, whatever income the person earns, there is no way we can disentangle. Suppose at the end of the financial year, the person has income of rupees 20 lakh. We cannot say out of this 20 lakh, rupees 1 lakh should be attributed to the interest that he should have paid himself for the capital that he employed. Rupees 15 lakh as or rupees 10 lakh as wages to himself for the labor that he put in. Rupees 8 lakh as profit because he was an entrepreneur. We cannot talk like that. So for such situations where the same person is doing everything, we have a new category called the mixed income of the self-employed. Okay, so the factor income coming out of production process in the domestic territory, it consists of three factors. A, compensation to employees. B, operating surplus, which has three things. A, rent. B, interest. And C, profit. Finally, we have mixed income of the self-employed. These three taken together give us the total factor income obtained by factors on account of production activity which takes place in the domestic territory. Therefore, it is called NDP-FC. But if you are interested in national income, then national income obviously it includes the incomes of all factors of production, whether they are giving services for production in the domestic territory or abroad. Therefore, we need to add to NDP-FC net factor income from abroad. The reason I'm highlighting this is that even in your book, there are a couple of questions, I think, which talk about NDP-FC as domestic and NDP-FC only. So we need to be clear. Whenever we are talking about factor income, we need to be clear whether we are including factor income from abroad only or home only or abroad. If it is from home only, then in order to arrive at national income, we need to add NFIA. I hope this is clear now. Expenditure method. I think some people miss expenditure method. I would very quickly say that expenditure method is about the different types of expenditure that are incurred on this output. So as I said, there are different categories. One is first is consumption expenditure. Final consumption expenditure, we call it private final consumption expenditure. Then this is consumption expenditure by households. Households, and one category which I think I should mention here is the non-profit organizations. Okay, not corporates, not the government, not household, but not profit, because since they are not part of the government or the corporate sector, they are also counted in this non-profit organizations providing different types of services. Okay, so but broadly for your purpose, you can say consumption expenditure by households broadly. So this is covered under the private final consumption expenditure. And then we have government final consumption expenditure, GFC. I have said this includes the consumption expenditure by the government, the different types of goods and services that the government provides, like education. Government had run several universities and schools and colleges and research institutions. Okay, government, then health expenditure, government hospitals, government dispensaries, government nursing homes, running them, police, regulatory authorities, different agencies, civil services. Then we have defense, etc. So that is a part of GFCE. Then gross domestic capital formation. Domestic capital formation could be by the government, could be by the private sector. This capital formation, there are at least 4 categories. One is the fixed capital formation. This I hope you know better. Fixed capital formation is investment in plants and machinery. Residential investment is the investment in units for housing purposes. If you construct a house, if you buy a new flat is constructed, that is investment is residential purposes. So residential investment. Then acquisition of valuables like jewelry, etc., gems and jewelry. And finally, changes in inventories. Okay, if inventories are rising, we say there is positive inventory investment. If inventories are declining, it's a negative inventory investment. The other name for this is change in stocks. Okay, I hope this is clear. Now let me take other questions very quickly. Now let me very quickly move to the second topic within this topic, that is the national income, determination of national income. I would have liked to do some numerical questions, but given the paucity of time, I would suggest that I move directly to the second topic. If in the evening we are left with some time, I would like to, I can take it then. But if you feel that I should take the numerical questions right now, please leave a comment. At the end of the session, I'll take a few numerical questions then. Okay, so I'll go by whatever you feel more comfortable with. Okay, the theory of national income that we study here was given by J.M. Keynes. Before I start, let me give you a brief background of why we need all this. And I think the present times should make it very clear to you that there are situations where the production activity in the economy declines to very low levels. And similarly, there are episodes when it rises to comparatively higher levels. Okay, so obviously when production process is less, incomes will be less. Okay, and if people don't have incomes and the goods are not being produced in the economy, you can understand it will be difficult for many people to survive. Okay, so in order to understand why at times the production declines to low levels and why at times there are instances of it rising also. So why it declines? But looking at, for instance, unemployment, why is it that the income levels decline to such low levels? one needs to understand the factors which determine national income. That we can have an idea about the policies that the government can use in order to bring the economy out of such episodes which are called recessions. Okay? In this topic, we will look at the basic model of income determination which was given by Keynes, starting a book which was published in 1936. As you must have studied in your 11th and 12th class macroeconomics, that the word and went through a very long episode of high levels of unemployment, which is called the Great Depression. Okay, and the then prevailing theory, which was called the classical theory, was not able to provide any answer to the question of why that recession was there, and therefore how the world economy could be brought out of that. Okay, Keynes came out with a book in 1936, which is called the General Theory. Okay, popularly is called the General Theory, but the title is General Theory of Employment, Interest and Money. That book and some work based on that did have ideas which was able to bring the world economy out of the Great Depression. In order to understand that model, first let me clarify that to get a clarity in ideas, it would be better if we, for the time being, keep ourselves confined to two sectors. So start with the two-sector economy, then we'll look at other economies. So two-sector economy, we just do two sectors, households and firms. In the three-sector economy, we have, apart from this, government also. And in the four-sector economy, apart from this, we have the rest of the world also. For the two-sector economy, it is important for you to understand something called the circular income. Before I come to that, let me make a few assumptions. Recall, in this economy, it should be clear that national income is the same as GDP at market price. Okay, we are assuming that there is no government. So if government is not there, the difference between factor cost and market price is not there. Economy is closed, so net factor income does not arise. So domestic is the same as national. Okay, and we're assuming that there is no depreciation for the sake of simplicity. So all the investment is net and as well as gross. Okay, so as you know, that way the national income, which is equal to NNP at FC, is simply equal to GDP at NP. So either way, let me call it Y. Okay, and since there are no taxes, that means neither there are indirect taxes nor there are direct taxes. So this disposable personal income, the shortened notation here for that is YD, that is equal to simply Y. Okay, so these are the assumptions about which we are proceeding. Let me look at circular flow of income. For that, let me take you through this diagram from your book. Yeah, this is the diagram that I wanted to show you. We have households here and farms here. What do households do? Households provide factor services. Okay, so they are providing factor inputs. This dotted line shows you real flow of factor inputs, and this monetary payment, complement. So in lieu of this factor inputs, the firms pay households factor incomes. Okay, then using this factor income, households buy goods and services. Okay, so this consumption expenditure shown here, this consumption expenditure, look at the lower panel. Consumption expenditure. This is the consumption expenditure, and in return for the consumption expenditure, the firms give them goods and services. So this is the basic flow. The households are getting income. for their factory inputs, and firms are producing goods and services using these inputs, and these are being given to the households in terms of goods. Okay, the consumption expenditure is going to the firms. So circular flow. The same amount firms are giving to the households are giving to the firms, and the firms are giving this amount to them as factory payments. Okay, so this is one thing. In this case, this is income, this is total expenditure. Okay, this is equal to national income. Now let us look at the question of equilibrium. We talk about equilibrium income. Of course, income level can be anything at any point of time, but we are interested in the level of equilibrium income. What is equilibrium income? First of all, look at understand the concept of equilibrium. Okay, equilibrium means a state of no change, which is a state of balance. And I think the best way, one nice way to understand the state of balance is to look at the balance that you use for weighing. Of course, now these days there are electronic weighing devices at all the stores. But in older times, we used to have these balances with which people used to measure. On one side of the balance, they used to keep a weight, and other they used to keep the good which they were supposed to weigh, for which they were taking a weight. So suppose in the left pane they are putting this 500 grams weight, in the right they will put some commodity, and when the two weights were equal, the bar from which these two panes were hanging would be straight. Okay, it would not tilt in either direction. We say it was in balance. Okay? So equilibrium basically means that there is a state of balance. There is no movement. Okay. The other way of looking at it would be, suppose you have a toy car lying on a surface and you are pushing it from two directions. If the force on this from the two directions is equal, then there will not be movement on either side. It will be in a state of, it will lie still. We say it is in equilibrium. If there is a force from one side which is exceeding the force from the other side, the toy car will move in the other direction. That is not a state of equilibrium. So equilibrium means it is a state of balance. There is a state of no change. We are interested in equilibrium level of income. Let me state the equilibrium condition. According to Keynes, the equilibrium level of income in the economy is where total income output being produced in the economy will be equal to aggregate demand. This is called aggregate demand. Or aggregate spending. Okay. Idea is total demand, or another name for this is planned spending. Planned spending. When these two are equal, total output that is being produced is equal to total planned spending, then output will be equal. Okay. Obviously, if the output that you are producing, if Y exceeds aggregate demand, then what happens? You cannot meet the demand from the production that you are undertaking now. You have to run down your inventories. We say unintended and therefore Y has to be raised. Similarly, when this Y is less than AD, then obviously the rest you will add to inventories. So you will, unless you cut down production, you will keep on accumulating inventories, which again is something that is not sustainable. So you would like to cut down on production. Okay. Only when Y is equal to AD is the case, then what you are producing is exactly what is the planned spending. So neither there is an intended addition nor there is depletion of inventory. So this is the equilibrium condition. Next question is, what is AD equal to? In a two-sector economy, we have two sectors only. Households and the firms. Households have consumption expenditure, firms have investment expenditure, and therefore AD is equal to consumption plus investment. Okay, so please be clear. In order to understand the equilibrium level of income in the economy, we need to understand the determinants of the two components of aggregate demand, namely consumption and investment. We assume here that investment is autonomous. That means it does not depend on income. Okay, now look at consumption. For consumption, Keynes had suggested that consumption is a positive function of disposable income. Consumption is a function of Y disposable. Okay, so as C rises, Y rises. What type of function? Now in this case, we are assuming that YD is same as Y because there is no government. So we can say in this case, simple model, C of Y. We assume a simple functional form, C is equal to A plus BY, where A is greater than 0. It is called autonomous consumption. Okay, it shows the consumption which will exist even when income is equal to 0. I hope you all understand. In order to sustain oneself, one has to consume some minimum, whether one has income or not. That is the idea of autonomous consumption. It is autonomous of income. And then we have B. Value of B is called the marginal propensity to consume. MPC is what it is called. And this simply shows you the change in income resulting change in consumption resulting from a given change in income. If a change delta Y in income leads to delta C change in consumption, we can say change in income, change in consumption resulting from one unit change in income is equal to MPC. And MPC value of MPC, we assume is lies between it is greater than 0. That means when income is rising, consumption will definitely rise, or when income is declining, consumption will definitely decline. But then if this B is equal to 1, that means delta Y is equal to delta C. Income rises, consumption will rise by the same amount. Income is declining, consumption will decline by the same amount. Okay, when we say B is less than 1, that means this delta C is less than delta Y. The change in consumption resulting from a given change in income will be less than that particular change. Okay, so for instance, suppose I say B is equal to suppose B is equal to 0.8. It means when my income is rising by 100 rupees, my consumption is rising only by 80 rupees. If my B is equal to 0.6, it means my B is rising. If my Y is rising by 100 rupees, my consumption is rising only by 600 rupees, and so on. It is called MPC. Before I proceed further, let me talk about another concept, another important concept that is called APC, average propensity to consume. This is equal to total consumption divided by total income. Consumption per unit of income. Okay. If you want, I can very quickly look at a numerical example based on this. Let me take you through to MS Excel. Which what it means. Suppose here I am measuring Y. Suppose my consumption function is C is equal to 500 plus 0.75y. So MPC is 0.75 and autonomous consumption is 500. Okay. So look at my C. Here I'll look at, now look at this. Y, suppose Y is initially 0, then declines and rise to 1000, then 2000, 3000. Suppose. And my consumption accordingly will be given by 500 plus so you may note as consumption as income rises to 1000, consumption rises to 1250. Please note as income is rising by 1000, consumption is rising by 750. Again, income rises by 1000, consumption rises by 750, and so on. So my APC will be equal to consumption by investment is equal to consumption by investment. Here, of course, it is not defined because you can't divide by 0, but for other values it is defined. Okay, you may note as income rises, APC goes on declining. Okay, and now let's look at MPC. MPC is equal to this change in consumption divided by change in income, which we can find. I'll quickly calculate it. This is consumption minus this is change in consumption, and this is change in income. (0.75), and you can see it is constant everywhere, 0.75. So as income rises from 0 to 5,000, consumption rises from 500 to 4250. MPC is 0.75 constant, but APC is declining, which should be clear to you because APC is equal to C by Y. As consumption rises, as income rises, consumption does not rise in the same proportion. Okay. Before I move to diagrams, let me also talk about another important function that is called the savings function. Savings is equal to simply Y minus C. Out of your income, whatever you are not consuming is what you are saving. And since you have assumed, I am doing it in Excel so that we can save on time of switching between Excel and Word. I can show you a numerical example right here. As C is equal to A plus BY, so S will be equal to, it should be clear, A minus A, it will be equal to Y minus A minus BY. That means it will be equal to minus A plus 1 minus BY. Okay, minus A plus 1 minus BY. What it gives is the following. Please note. When income is equal to 0, saving is equal to minus A. Obviously, when you are consuming without any income, that means you are running down your savings or you are borrowing from somewhere. This is called dis-saving. You can see when income is equal to 0, you are dis-saving, and this dis-saving is equal to A. Then 1 minus B is called MPS, marginal propensity to save. Okay? This is what this is the change in savings per unit rise in income. Okay, it should be clear. B is less between 0 and 1. B is less than 1. So 1 minus B will also be less than 1. Okay, and B is a constant, so 1 minus B is also a constant, so it will also be a constant. Let me calculate these values here. S. Savings. APS and MPS. Savings will be equal to income minus consumption. As income rises, savings rise from minus 500 to this much. Please note, savings rise to by 250 is rising by 250 at every stage. Okay, we should be clear. When income is rising by 1000 units, MPC is 0.75. So when income is rising by 1000 units, consumption is rising by 750 units. Obviously, out of that, every 1000 rupees, if 750 rupees is going to consumption, the remaining, that is 250 rupees, is what is being saved. That is what. So, and 250 rupees as a proportion of 1000 is equal to 0.25. So if MPC is 0.75, MPS is 0.25. Income is rising by 1 rupee. B rupees are being consumed, but obviously 1 minus B rupees will be saved. So B plus 1 minus B, MPC plus MPS will always be equal to 1. Okay? APS is simply S by Y is equal to S by Y. Initially it is infinity, but then you can see it declines. It rises, and MPS is savings, change in savings. Change in this minus this divided by change in income. Okay, 0.25, it continues to be 0.25 because it's a constant. I hope this is clear. Now let me show the same stuff diagrammatically. Okay, and then we look at the equilibrium condition. I think we are slightly running short of time. I need to show you, not MS Word, but let me just look at this. From your mathematics, you would recall that A is the intercept of this line and B is the slope. Okay, A is in consumption function, A is positive. So that means this will have a positive slope on the y-axis. Number one. Number two, slope is equal to 1 minus B, which is less than 1. I hope you have studied that slope of the line gives you the tangent of the angle that makes with the horizontal axis. Okay, if the angle is 45 degrees, the slope is equal to 1. If the angle is less than 45 degrees, slope is less than 1. We have said B, which is the slope of the consumption function, is less than 1. Okay, that means the line will have a slope less than 45 degrees and it will have a slope positive. So we can draw it in the following way. This is how we draw it. This is my vertical axis. And then this is my horizontal axis. There's some problem, it seems. This is my horizontal axis, and then I'm drawing this as my consumption function. Okay, this is my intercept. Here I'm measuring my consumption, and here I'm measuring my income. This is my value of A, autonomous consumption, and this is my value of income. This is my consumption function. If you want to understand the value of B, what B is, let me draw a horizontal line here. Look at this angle that this black line makes with this horizontal line. The tangent of this angle is what gives me my MPC, that is my B. Okay, so this is my consumption function, positive autonomous expenditure, and then positive slope, which is less than 1. Okay. If I want to draw my savings function, I can do it similarly. But please note that this savings function will have negative intercept. So this will be drawn like this. Negative intercept but positive slope. So this is negative intercept, this is equal to A, this distance is equal to minus A. This slope is equal to B, this will be equal to 1 minus B. You can understand if B is large, 1 minus B will be small. So if this B is large, then this will be steep. And if this is steep, this will be flat. So if this is flatter, this is steeper, this is steeper, this is flatter. That should be clear. Here I'm measuring income, here savings. Here I'm measuring income, here I'm measuring consumption. Okay. So this gives me my amount of this saving. Okay. And as we have seen in the Excel sheet, as initially the income is 0, consumption is savings is negative. There is this saving, but as the income rises, savings goes on rising. At one point it becomes 0, and then it becomes positive. Consumption, of course, is always positive because the APC, the autonomous consumption, is always positive. So this is positive, and as income rises, it only rises further. So it's a positive slope line. So this is how we show this is the consumption function. This is C. C is equal to A plus B. A plus B Y, and this is my saving. S is equal to minus A plus 1 minus B times Y. This is how we show these. Okay. So I hope these diagrams are clear. Now let me come to the income determination in the two-sector model. The same similar diagram is given in your book. Look at this 45-degree line, and since B is less than 1, the slope of this line is less than 45-degree line, so it is flatter as compared to 45-degree line. This is my this, and income. I'll come to this 45-degree line in a short while from now. First look at this consumption, this autonomous expenditure, this is this saving, and this is the investment saving function. Okay. Look at the slope, look at this line. This line is very crucial. Before we understand the idea of consumption, of equilibrium, let's look at this line. If I want to compare the level of consumption with income levels, what happens? Okay, please note when income is equal to 0, consumption is more than, income is equal to 0, income is less than consumption. But please note that as the income is rising, consumption is not rising in the same proportion. So it is possible that at some level, consumption will fall short of income. Okay, how do we know whether consumption is equal to income or less than income or what? Okay, because consumption is being measured on this axis and income is being measured on the horizontal axis. Then how do we compare the two? Comparison of the two is made easy by looking at this 45-degree line. The 45-degree line, as you must have studied in your microeconomics course, in mathematics course, its equation is y is equal to x. So if you look at any point, this distance is equal to this distance. So this 45-degree line is a geographic tool for us to map this distance into this. Suppose I want to map this distance A. I want to see as to what is the horizontal distance equal to this vertical distance. All I need to do is look at the value on point on the 45-degree line. Okay, corresponding 45 degree line is this, and for this 45 degree line point, just look at this. This the corresponding. I think it will be clearer when I go to paint so that I can draw it myself. Suppose this is my 45 degree line. Okay. Now suppose I am interested in this point. What is the point? Suppose this is a point. Let me call it slightly mark it. This is one point. Okay, and I want to see this is my vertical distance. What is the corresponding the horizontal distance? For that idea is very simple. I look at the corresponding image of this in the 45 degree line. Corresponding point 45 degree line is this, and on the 45 degree line, if I draw another line here, so the image of this point on the 45 degree line is this. So this vertical distance is equal to this much horizontal distance. Similarly, corresponding to this horizontal distance, this is the vertical distance. So whenever I want to compare some vertical distance with some horizontal distance, all I need to do is I need to look at the image of that particular point on the 45 degree line. And that's a very important tool for me here, for the reason that consumption, we are equating consumption with income. In order to make it further clear, let me come to the equilibrium condition now, because our objective is to find the value of y at which the economy is in equilibrium, at which y is equal to AD. And for that, let me make another diagram. Okay, this is my consumption function. We have said equilibrium condition is y is equal to c plus I. I assume that I is a constant. And you know, if I want to add a constant to this, I just add a line parallel to this. So if this is my consumption, C is equal to A plus B Y. If I want to add investment to this, adding investment to this will give me a line parallel to this. So I'll get a line which is parallel to this, which will be this. Okay, this is my C plus I. C plus I. Okay. As y rises, C plus I rises. The question is, at what level is y equal to C plus I? Here, the 45 degree diagram comes to my rescue. Let me draw the 45 degree line in this diagram. Look at this. Corresponding to this level of C plus I, this is the level of, this is the vertical distance. Okay, let me draw a look at this level. Suppose this is my income level. At this level of income, my level of aggregate demand is this. At this level of Y, you can see this is the level of this much is the level of this much is the level of aggregate demand, this vertical distance. But what is the level of income? Level of income is in vertical terms, it is only this much up to 45-degree line, because for this horizontal line distance, this is the equivalent vertical distance. So that means this vertical distance corresponding to the C plus I line is more than that corresponding to 45-degree line. That means aggregate demand exceeds my output level. That means income level has to be raised. So this is not a point of equilibrium. Look at this line then. This point correspond to this level of income. The point on the 45-degree line comes at this height. So this corresponds to this horizontal distance. This is the vertical distance. So this is the level of Y, and this is the level of aggregate demand. Aggregate demand C plus I this much. So C plus I is less than Y. So at this level of Y, AD is less than Y. That means level of Y needs to be reduced. We move in the leftward direction. And corresponding to this, at this level of Y, it is more. You can see when 45-degree line and C plus I intersect. C plus I, for given level of Y, C plus this line gives us the level of aggregate demand, and this line gives us the level of Y. When the two are meeting each other, then you can see C plus I is equal to Y. So we get the first result. Equilibrium level of income we get diagrammatically as that level of Y at which Y is equal to C plus I. Okay, and that geometrically is obtained at that point at which the C plus I line meets the 45-degree line. If Y is more than that, that is, if you are to the right of that, if the level of Y is such that you are to the right of that value, in that case, this Y is more than this C plus I. So there is excess output, excess supply of output. On the other hand, if you are to the left of this, then C plus I is more than Y. Aggregate demand is more than output, which means there is excess demand for output. When the two are equal, then there is no such thing. So this is the way to look at it diagrammatically. Okay. Now let me look at it geometrically. Let me see. We are just left with 2 minutes. So let me see if there are any questions which need to be answered right away. Then we'll take this discussion forward in the evening session. If this idea is clear to you of this 45-degree line and MPC, EPC, etc., then not much is left in this topic. Of course, we need to do multiplier, etc. But this conveys the basic idea. The other question. The question suggests that I need to do some the main point coming out of the questions is that I need to do more numerical questions. So once I finish this topic, I'll do numerical questions from the national income as well as from this. I think it is 10 o'clock, so we have to stop right away. So I think we need to stop now. It is 10 o'clock. So we will resume the session at 9 o'clock in the evening, 7 o'clock in the evening. And as I can see from the suggestions received from all of you, I will, once I finish this topic, I will take numerical questions from this topic, and then I'll proceed to the topic on public finance. So I think we'll stop here for now. Okay, so thank you very much. See you in the evening.